we use the high frequency sort of daily, weekly data on demand. So I think JP Morgan feels we've got, we're constantly changing it, of course, as economies come under off and lockdown. But it's sort of that demand trajectory. I think you're right what you say about refineries. Refinery margins, I would argue, in most places have been not particularly good this year, but also if you go back to last year. So there's definitely a concern around the refining sector that if demand recovers better than we'd expect, that you start to see refinery utilization turn up quite high, and then we again get that sort of flooding of oil products, etc. And then I think longer term, the concern, like I mentioned before, is the inventory overhang. If I was going to say to you in the first half of this year, according to our the estimates that the world put in 1.6 billion barrels of oil into storage. So that overhang's got to is gradually taking time. Having said that, this morning on our house view for Brent, we put up our Brent assumptions this year to $40 and next year $47.
We had a strong jobs report out from the US, of course, on Friday, blowing past all expectations. How bullish is that data point for the oil markets, or is it seemingly taking a back seat apart from what OPEC did?
Well, look, we look at, coming back to the sort of the demand data, we look more at what's happening on a sort of week-on-week or daily basis on demand. I mean, it's not as if we take a sort of our forecast of GDP and then link to what demand what trajectory is. So we're looking at it, whether it's daily traffic data in China or US or gradual recovery in aviation demand, etc. So we think there's rebalancing. It started to rebalance. We changed our forecast on sort of global oil deficit to sort of July based on the OPEC rolling over in terms of production cuts. So, look, I think it's a gradual sort of change in terms of rebalancing. If you take a look back, the oil industry, these oil price levels, that's not enough to incentivize me if I was an oil company to invest aggressively in the oil sector. We're seeing global capex down 20% this year. And I'd argue if you go back to sort of the last collapse, the oil industry has been cutting back on spending and returning more cash to shareholders. So there is a definite view that more longer term, we haven't invested enough in the oil sector. You've got rising existing field decline rates. So it would take, if we take a medium-term view where demand growth sustainably improves, this is why really we have a Brent forecast of $60 in 2023, which would show significant upside on where we are now and also to some of the oil equity